How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you what to do with your 401k plan and how to effectively create some sort of goal or some sort of strategy that fits specifically to what you want to accomplish, whether that's just on a growth play and leave a maximized inheritance for your loved ones, or essentially try to consistently grow your monies and utilize that for retirement income at a later date and time, and really try to expose what are the different options available to you guys if you currently have a 401k plan, and then avoid the most common mistakes that individuals make by just kind of shooting from the hip and taking a guess on their 401k after they hit a specific age, or after they start nearing those retirement years, and the ones that are not set up for a specifically designed plan. So to take a step back, what exactly is a 401k and what are some of the problems that individuals make when they're nearing their retirement? A 401k is a type of qualified retirement plan, the qualified employer-sponsored retirement plan, meaning that when an individual is working for a company, they're getting paid some sort of salary. On top of it, one of the incentives to have that employee stay with that employer is to offer them different employee benefits, such as, health insurance or a group life insurance plan, or a type of retirement plan that they could contribute their dollars that they're getting paid into each and every month, each and every year. So as an easy example, we're just going to say that this individual is making $100,000 in a given year, and this company is giving them a 401k plan that they could invest their dollars into. So if this person says, I want to put 5% of my salary into the 401k plan, they're taking $5,000, 5% of the 100,000, and that's being placed into this bucket. On top of it, one of the benefits of a 401k plan is if the employer does something known as a match. So what they'll say is, we're also going to match up to a specific percentage amount of your salary, of what you're contributing into this plan. We could match to give you a further incentive to stay with our company, company ABC, as opposed to going with company XYZ that might be paying you more money but doesn't have a match. So it's all about incentives, all about the company taking care of you, or at least allowing you to place money aside so it's out of sight, out of mind, and allow those monies to grow on a very tax deferred or efficient basis. So let's say if we had a match of 5%, and this person puts in $5,000, that means that the company is going to match them $5,000 as well. So therefore, $10,000 is going to be the total contribution into that plan for the year. Let's say if this company only matches them 3% and this person put in 5%, they're going to put in $5,000. The company is going to pay $3,000 into that contribution through that match. So therefore, only $8,000 is going to be the contributions into that year. So the contributions are obviously a large key to growing that bucket, because obviously you need to put something in that bucket in order for that bucket to grow. If you didn't contribute anything to your 401k, well then obviously that 401k is not going to grow. But the opposite side of the coin is also what percentage rate that this comes back at, meaning that your 401k is not only going to be added by the contributions that are being made into that bucket, but also whatever the percentage rate that is tied to the different investments within that 401k come back, whether that's favorable or unfavorable. And what I mean by that is, typically with 401k plans, they give you options to choose from and options to invest those monies into. So you might have anywhere on the low end about 5 funds to choose from, to on the high end about 25 different funds to choose from. And ultimately what this says is, okay, based upon your risk tolerance, you could go into a conservative fund, you could go into a moderate fund, you could go into an aggressive fund, you could go into stocks, bonds, ETFs, mutual funds, all different plethora of options, between 5 to 25 different options, different eggs to choose from that you could allocate. You can make proper allocations, and based upon how those funds perform would determine whether you're going to have a positive interest credit that's added into this bucket or a negative interest credit that's added to this bucket. So individuals that were set up in the 1980s into their 401k plans, they understood that these funds that they've contributed and that was invested into the stock market typically had a very high rate of return. So they were able to place their dollars in there, get a match that was an additional contribution into that account, and then you have a very positive very positive interest credit that's coming back. So they're essentially leveraging that power of compound interest to have this bucket grow higher and higher, larger and larger and larger at the end of the day, at the end of the year. But what they unfortunately forgot about is that the stock market can go down as well. These funds, these limited funding options between 5 to 25 options, are most likely not going to be the best quality out there. And essentially, they're handcuffed to only these options that they could choose. So, like in 2008, as a prime example, the average portfolio went down from 30% as high as 60%. Some were lost even further of a drawdown than that 60% number. But on average, about 30 to 60% was the average losses with 401k accounts. So that means, and let me clear up the screen. So that means if an individual was contributing their dollars, they were getting company matches, all of those monies were going into the bucket, and you were having positive interest credits from those mutual fund options or those funding options that you chose. You're probably thinking, wow, this is incredible. All I have to do is throw money at it and everything's going to go up. It's just going to compound higher and higher and higher. Well, you have those baby boomer generation. You just have regular individuals that said, okay, I might want to call it quits in the next 5 to 10 years. And they walked into 2008. Maybe they walked into 2008 with 500,000 sitting in their 401k account. And then, bam, they get hit with a large downward market loss. This interest credit came back negative. So therefore, it completely eliminated all those contributions, eliminated those growth. They got hit with, we'll call a minus 50% loss. They walked into the year with 500,000. They walked out of the year with right around $250,000. So they all lost the equivalent of a house, even though they didn't have, $500,000 is obviously a lot of money. $250,000 is a very large amount of money to lose in that given year, especially when you're banking on this 500,000 to leverage for retirement income. So this is when individuals are trying to figure out what to do with their 401k. The first thing is to eliminate those losses, eliminate the negatives that are associated with that bucket, and try to accentuate the positives, try to accentuate that power of compound interest. And if they're eligible to utilize this 401k, and if they hit certain age requirements, or they have an old 401k and now they could do certain rollovers, how do you roll over those contracts properly that fit like that will be ideal for your exact situation, fitting like a perfect puzzle piece for your ideal situation? And the very first problem that I want you guys to understand, or the main problem that I want you guys to understand of that little example that I was showing you, was something known as reverse dollar cost averaging. When you have your money invested with 401k related accounts, you have 401k related fees associated there. If you tie those monies, if you use the funding options and they have mutual funds in there, well, then you're going to have mutual fund related fees within those accounts. If, let's say you're utilizing an outside advisor, a financial advisor, and he's trying to charge you an advisor fee, he or she is trying to charge you an advisor fee, that's a third negative, just to monitor, what those accounts are doing. So if you think about this bucket, we're going to poke a couple holes on the bottom of this bucket. Those are negatives. If, let's say, you just keep letting it ride with the 401k and you don't set up a specific plan, well, now you're subject to downward market loss potential like those individuals in 2008. And there's many examples of that growing your monies. The problem that I want you guys to understand is you can't afford those downward market losses if you're trying to pull monies from those accounts. If you try to pull out income from those accounts, well, you're pulling out income. You have that potential of downward market losses. You're still paying all those different fees. Well, now we're putting big holes into this bucket, and therefore a bunch of money is leaking out towards those fees, towards those, those advisors, towards that downward market loss, and there's no real safety net that's in place. Then you have different things such as inflation, which says that you might have to pull out more and more monies in your later years to combat inflation, the cost of goods and services rising. And then you also have longevity risk. How long an individual with technological advances, medical advances, individuals are living longer and longer and longer. So when you have insurance companies that they're utilizing their actuarial data and they're running through statistics, it's showing that males are living longer, females are living longer, couples above the age of 60 are living longer. All these different things come into play. So therefore, how exactly can we counteract those problems and utilize what you've already saved on your 401k to roll it over into specifically designed contracts? Or if you're still subject to that 401k plan, how to make sure that you're stopping the bleeding and you're taking a strategic approach until you are eligible to roll over different portions of those monies into segmented processes or segmented accounts. And the first solution is to understand what is your goal. How old are you right now? When are you looking to retire? What are your expenses going to be at retirement? And we have different expense budgeting sheets, different things to help you out with that. And then we're able to optimize that or correlate that to inflationary risk on some, inflationary type expenses and leave the fixed expenses fixed without increasing. But ultimately, what is your exact number of income that you need on an annual basis? So if we're using a hypothetical example that we have an individual that's age 60 and they say, okay, I want to trigger Social Security income at age 67, and that's when I want to retire, that's when I want to call it quits, that's when I never want to work again, or maybe work part-time. Well, therefore, we understand what that number is. So what we could do is plan on what and figure out what those expenses are today to therefore project what those expenses are going to be at age 67. Let's just use an example, a hypothetical example, that this person at age 60 currently has $500,000 in their 401k account, and at age 67, they need $60,000 of income to live off of each and every year. Well, the first thing that we're going to try to tackle, and this is just a generic example, but understand there might be certain things, certain trigger points that you're thinking about as I'm talking about this situation that might correlate a little bit more specifically to your situation. So what I mean by that is the very first one that we want to figure out is income sources. What are your income sources? What are your guaranteed income sources at that age 67? Majority of individuals are offered Social Security income at that point in time. Let's say in this situation that this person is married and him and his spouse, or her and the spouse, are going to be receiving, they need exactly $60,000 of income, and then at that point in time, they're going to be receiving $45,000 of Social Security income. So with that example, that tells us that they are receiving an income stream of $45,000, but they need $60,000 of income, well, then their gap is going to be 15 grand. The very first process that they could do, because they've already attained age 59 and a half, if their company allows them to do so, they could take a portion of this 500,000, roll that over into an IRA annuity contract that has a 7-year deferral and therefore will trigger joint lifetime income. So maybe out of that plan, to provide $15,000 of income with a 7-year deferral, maybe that's only going to cost them 100 grand to place it into a safe, consistent account, typically a hybrid annuity, so something that allows them to still have control, and then trigger lifetime income through an income rider to therefore produce that $15,000 at that point in time, at that age 67. So bam, the income sources are covered. The secondary aspect that individuals need to figure out preparing for retirement, or if they're currently retirement, are emergency funds. At that point in time, when they're 67, they want to have sufficient amount of emergency funds in case they come to a healthcare scenario, in case they come into some sort of oh my gosh moment, that they could pull from an account that's completely liquid. An annuity is good, but the downside to annuities are you're utilizing specifically designed contracts that are set up for that 7-year deferral, or for that 1-year deferral, for that 2-year deferral. So yes, there are certain get out options, but typically when you set your accounts into an annuity contract, you want that contract to do exactly as what it's designed. You don't want to put a dollar more or a dollar less than what you need to get out of that specific insurance related IRA contract. So with these emergency funds, rule of thumb is to keep about 6 to 12 months of savings into emergency funds. So maybe, take $60,000, we'll call it $50,000, and throw that into an IRA money market account that is not going to really have gains, but it's not going to have any losses. Just something that's kind of sitting there like a regular cash account that you could dip into in those later years. So therefore, we understand the first the first IRA used $100,000. That was with an IRA annuity. The second IRA was $50,000, and you're doing a rollover, $50,000 into an IRA money market account. And now the third aspect is that inflationary protection. So the income sources, we covered that longevity risk. The emergency funds, we covered that short-term risk, that liquidity risk. And then this third option, you could use a plethora of different avenues. You could use annuity laddering strategies that will step up your income every few years, so you're utilizing micro shares of that. Or you could just simply stay put with that whole 401k concept and put that into specifically designed IRA accounts that are tied to upward market movements or tied to the stock market. So when you set it up in an IRA, the difference between that and a 401k is a 401k is going to give you between 5 to 25 funding options on average. when you set it up with specifically designed IRA contracts, that could be anywhere from 2,000 to 3,000 different funding options. So it could be more specific. You could have a lot lower cost, much higher quality type funding options to choose from. And therefore, that could be your third bucket to say, I want this to grow on a safe, consistent basis. I want to make sure that I'm eliminating fees onto that account, that I'm eliminating those negatives. And therefore, you have 350,000 extra dollars to play with to basically grow those accounts more effectively, more efficiently than the 401k plan. You're already preserving that 500,000. You're now segmenting those 3 lanes properly. You're setting it up like a perfect puzzle piece. And now for these next 7 years, when you're making contributions, and let's say if you're getting a match, well, that's another avenue that you could set up a 401k optimization strategy to make sure you're picking the most efficient funds because you're getting free money with that match. So that's going to be the most basic concept of what to do with 401k monies, is just devise it or segment them into a precise goal, a precise strategy, and it might be, you know, certain segments of strategies to utilize 2 different IRA contracts, you know, 5 different IRA contracts, whatever it takes to get to your ultimate retirement goal and to make sure that you have pure confidence in retirement. Another avenue that some individuals in very rare cases they might say, listen, I've accumulated this 401k account. I already have Social Security income. I already have pension income. I have more than enough, you know, I know exactly what my budget is. I already have my income sources covered. I already have my emergency funds covered. I already have my inflationary risk covered. What I want to do is use this 401k and try to maximize this out as an inheritance to my loved ones. And then that's when you could utilize something known as like life insurance arbitrage strategies, where you're triggering income streams that therefore pay for something known as a GUL life insurance policy that has a maximum tax-free death benefit attached to it. So there's a whole different slew of options available to you. It just really depends upon your individual situation. And one of the things that really irks me, it's one of my biggest pet peeves, is when I get calls into the office and an individual says, you know, I sat down on a seminar and this advisor was telling me about this really good annuity contract or this really good one strategy, and you know, there's 50 other people at the seminar. We were all talking about really great things about it. At the end of the day, your situation is going to be entirely different than your neighbor, entirely different than the individual that's 5 years younger than you or 5 years older than you. And the odds that all 50 of those individuals sitting at that seminar all need to have that same strategy are very slim to none, because it does not incorporate those different specifics involved. So, you know, I hope that this gave you guys some food for thought. And let me clear out the screen. If you're interested in hearing more information, whether you're nearing retirement, you're just trying to safely accumulate your 401k plan, or you left an employer and now you have an old 401k, feel free to give us a call. It's 1-800-566-1002, and we'll have a specialist standing by to help you out. We offer 24/7 customer service, so you give us a call mornings, nights, weekends, holidays, whatever the case may be, and we'll always have somebody answering the phone. Based upon your situation, that assistant's going to patch you over to a specialist, and that specialist is going to ask you a slew of questions. You know, what's your point A? Where are you right now? Where do you want to go? What exactly do you want to accomplish? At that point in time, you know, is what you're doing right now going to accomplish those goals, or should you make very slight tweaks and therefore it could have an overall much larger result, you know, to give you that confidence, or to show you that success on how to set up your retirement planning needs. So, you know, I really hope you found value in this. We're A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints just because of our methodical process. I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.